Okay, so we will continue with our discussion in this video lecture. Okay, so we are now in auditors' responsibilities on the related parties and their transactions. Okay, so since the related parties are not independent from each other, PS 24, the standard established the financial reporting and disclosure requirements for our related party relationships, transactions, and balances. This is the purpose of this is to enable FS or financial statement users to understand the nature and what are the effects of this relationship and transactions on the financial statements. Okay. So in relation to the audit of the related party transactions, here are the related responsibilities of the auditor, okay, for such. First, the auditor will perform audit procedures to identify, assess, and respond to any risk of material misstatement that may arise from the entity's failure to appropriately account or disclose their related party transactions or relationships as well as balances, which is in accordance with the requirements of the standard, okay, or of the applied framework. Okay, so this is what the auditor is after. Okay, if the entity have accounted for and disclosed their related party relationship and transactions and balances accordingly, okay, to avoid misstatement in the FS. Okay, another is the auditor should also obtain the understanding of the entity's related party relationship and transactions that is sufficient to conclude whether the FS did achieve a fair presentation or their FS is not misleading, which reflects the true nature of this relationship and transactions. Another is to evaluate also whether one or more fraud risk factors are present, okay, because fraud may be more easily committed in these types of transaction because in this case they might not charge any price, okay, and because of that there might be some anomalies that may exist, okay, between this in this transaction between the related parties. Next, an ordinary audit, however, cannot expect to provide assurance that all related parties and their transactions will be detected, because in this case it is the management's representation and disclosure that the auditor will check, okay, or will determine whether there is indeed related parties, okay. Nevertheless, an auditor should be aware, okay, that there might be some possibility that material related party transactions may exist. So again, it is still the responsibility of the auditor to make sure that he will detect and determine if there is indeed related parties, okay, that exists. So even though an audit is properly planned and performed by the auditor in accordance with the PSA, so there is still an unavoidable risk that there might be some material misstatements on the FS that may remain undetected. Okay, so this is this is why there is audit risk. Okay, and the auditor cannot provide 100% assurance and only reasonable assurance. Okay, so in the context of related parties, the potential effects of inherent limitations on the auditor's ability to detect material misstatements are greater because of the following. First, management may be unaware also that they have this related party relationships and transactions. Probably they do not know how to define it, okay, and they include these transactions in their normal and ordinary transactions with their clients or suppliers or customers, okay, but in reality they are related party. So particularly if the applicable financial reporting framework does not establish, okay, related party requirements, So again, depending on what the entity is following, and but most likely, okay, they will follow PFRS. So there is a provision for such. Okay, but the problem will be if the management is not able also to identify that they have related party transactions in relationship with those. Okay, another is related party relationships may present a greater opportunity, okay, for collusion, concealment, or manipulation by management. So meaning it is intended by the management not to inform the auditor that there is related party transactions. Probably the entity did not include it in their disclosure, or did not present it, okay, in any documents to the auditor. Okay, so the auditor should have a level of knowledge, okay, of the entity's business as well as their industry for him to identify the events, transactions, and practices that may have any material effect on the FS. Okay, so the existence of related parties and transactions between, okay, them are important to the auditor because, first of all, it is a requirement by the standard. Okay, for example, in PFRS, okay, to disclose in the financial statements certain related party transactions and relationship. Okay, another is the existence of related parties or their transactions may have an effect in the FS. For example, the entity's tax liability and expense may be affected, okay, by the tax laws, which require special consideration with respect to the related parties that exist or related party transactions. Okay, so that is another concern of the auditor. Another is the source of audit evidence, okay, because this will affect the auditor's assessment also of their reliability. So a greater degree of reliance may be placed on the audit evidence that is obtained from or created by unrelated third parties. Okay, because we've discussed this before, the sources of audit evidence that are considered more reliable. However, if in that case, the auditor did not know that the party that he collected the evidence from are the related parties, so it may have some doubt, okay, or difference, okay, because these parties have a relationship with the entity. Okay. Another concern of the auditor is a related party transaction may be motivated by other ordinary business considerations. So that this may be what we mentioned earlier as a form of collusion or fraud. Okay. So in the absence of evidence to the contrary, this transaction should not be assumed to be outside the ordinary course of business. But of course, the auditor should make sure that he assess, okay, these relationships and transactions as having qualified to be classified as related party transactions. Okay, however, the auditor must also be aware of the possibility that the transactions with related parties may have been motivated, okay, by conditions that are considered outside the ordinary course of business. So that's why the auditor should make sure, okay, that this indeed are disclosed, okay, or identified as related party transactions. Okay, so such condition, okay, so this condition will include lack of sufficient working capital or credit to continue business. Okay, that's why the entity entered into a related party transaction to save them from this financial problem. Another is an urgent desire for a continued favorable earnings record in the hope of supporting the price of the company's stock. So again, financial related concern of the entity. That's why they entered into a related party transaction to save them from losing. Another is dependence on the single or relatively few products customers or transactions for the ongoing success of the venture. Okay, so that's why they have entered into related party transactions again, so that the entity will be able to continue in the long run. Another reason is overly optimistic earning forecast. Okay, declining industry characterized by a large number of business failures. So again, to save the entity, okay, from losing. Another is they have excess capacity. So this means a loss or expense also on the part of the entity. Okay, so for them to survive, they might have entered into related party transactions. Another is significant litigation, especially between the shareholders and the management. Okay, another is significant danger of obsolescence. Okay, so that is also an example of losses, okay, that the entity should avoid. Okay, so those are the auditor's responsibilities on the related parties and their transactions. So all of this should be understood at least, okay, by the auditor for him to perform the appropriate audit procedures.